Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, markets have been looking for a sense of direction. They've been looking for a catalyst. We've had some optimism and markets pushing towards all-time highs, particularly in the US, but then they've stagnated. We've seen rotations beneath the headline indices level. So we've seen things like the inflation trade, then we saw growth stocks pick up. But the overall market has been starting to slowly stagnate. It's looking for something to give it another leg higher or potentially for the bull market to unwind. And this week, there were a number of potential catalysts. If we think about technology stocks, for example, we're in the midst of earnings season. And in the US in particular, some of the biggest technology stocks were releasing their earnings for the last quarter. And the tech stocks on the whole did very well. I mean, you would have seen headlines like Google's blowout earnings. You would have heard that they smashed expectations, and that's probably underplaying it somewhat. So their share price rallied. Microsoft didn't do as well as people had hoped, but it wasn't a disaster. Apple, similar situation. So overall, technology stocks, well, their earnings were good. So that was a positive for something like the NASDAQ 100 and the wider market in general. But it wasn't anything that caused the market to explode higher. Another potential catalyst was the US president himself. So he's reaching the first 100 days of his presidency, which is always a key moment and something that analysts like to reflect upon. And he also, at the eve of his 100th day, announced or pitched some $4 trillion worth of overhauls to US benefits. And that was obviously greeted with some optimism as well. But again, it wasn't enough to cause the market to spike higher. I mean, in the last week, Joe Biden's been doing some sort of one good, which is obviously the stimulus measures, but then also matching that with one bad, which is the idea of how you're going to pay for that, which was taxing the wealthy. So we saw a small pullback on certain asset classes, equities. Some people said Bitcoin's pullback was partly to do with the possibility of having to pay more tax on capital gains in the future, and people were taking some profits. Whether that was true or not, who's to say? But of course, Joe Biden has done very well in these first 100 days, if you look at the stock market as an indicator, that is. And actually, if you have to go back as far as the 1950s to find another president where the stock market had rallied more in his first 100 days. So again, nothing to send the market higher or explode higher. It wasn't enough to do that. And then the other thing we had, of course, is the Federal Reserve. And the Federal Reserve seems to have a special place in the market's heart. It always has its attention because they're focusing on what the Fed is going to do with its monetary policy. There was a meeting this week. The Fed kept interest rates on hold. There was no sign of any kind of change to monetary policy or unwinding of QE. In fact, the Fed went to great lengths to say that they wouldn't be changing their monetary policy anytime soon. It was always going to be accommodative until there were signs that they needed to act. In fact, they also said that they wouldn't let inflation get ahead of itself, although they thought it would be transitory. That was their way of trying to control the rise in bond yields. But what was interesting, we saw a pullback in bond yields. So if you look at the 10-year US Treasury yield, in the last week or so, we've had quite a range. We've dropped down to about 1.54, and now it rallied up above 1.6%. And then it pulled back after the Fed's announcement. But today, as I make this video, we've now seen yields spike higher once again, and we're pushing to around about 1.67%. So it feels like the reflation trade, there were some people already calling the end to that particular trade, but there are signs that it's starting to reinvigorate once again, and people are worried that inflation might start to pick up and that the Fed won't actually do anything about it until the 10-year US Treasury yield, for example, is way above 2%. So we'll have to wait and see. But overall, if you look at the market, none of these things have been a catalyst as yet, at the time I make this video, to see the market push higher until it's like next leg higher, or to collapse as yet. If bond yields keep rising, that will obviously have an impact. If you go back to past videos, you've heard me talk at great length of the impact of the rising 10-year US Treasury yield and yields on bond markets more widely. If they do continue to rise, we're likely to see the reflation trade continue or reignite, which could be good for things like cyclicals and some of the value plays out there, but be bad for growth stocks. If you take a quick look at where markets are, then the S&P 500 has finally broken above 4,200. It seemed to get stuck just below that for the last week or so. I mean, we've seen record highs on US stock markets in recent weeks. We're still around that level. The FTSE 100 is being pushing back above 7,000, having revisited, or should I say visited, that number in the last couple of weeks. We've gone back there once again. So overall, markets are still very positive. They're very constructive, but they're just looking for something to be the catalyst to propel them upwards or for them to unwind. And if we do see something, the market unwind slightly, and that's equity markets I'm talking about, in the sort of coming days, then do look back at each of the first 4 months of this year, and you will notice a trend. At the beginning of the month, the markets are rallying, and at the back end of the month, they're starting to sell off. So is that something that we're going to see more widely through the rest of 2021? We'll definitely have to wait and see. But obviously, as we now move towards the summer months, then it'll be interesting to see what happens. Are we about to see markets explode higher, given all this spending by the US government and the Fed maintaining its accommodative stance? Or are we going to see the COVID numbers worldwide start to explode higher? Of course, we've seen the horrific scenes in India and their rising numbers of cases every day. It was last week that we saw 300,000 cases or new cases of COVID-19 every day in India. And of course, if that starts to filter out into the wider world, then people are starting to become concerned and slightly wary that perhaps we could see further lockdowns elsewhere if the virus starts to spread once again and we get another wave in the UK and in the US. But obviously our vaccine rollouts have been particularly good. So we'll have to see what happens. There is some nervousness in the background. So in the coming days and weeks, keep an eye on the headlines, but pay particular attention to that 10-year US Treasury yield. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Twitter, moneytothemasses with a number 2. And you can contact us via Instagram. We're obviously on Facebook. Don't forget to join our Facebook group, facebook.com/groups/money to the masses. And of course, subscribe to our YouTube channel.